All right, so every individual has different financial need, hence every investor has a unique investment plan. There are many tools, facilities extended by fund houses to meet the expectation of different type of investors. One such facility is a systematic withdrawal plan or SWP. Let's welcome on board Bharat Phatak, Director, Scripbox, and understand more about a systematic withdrawal plan. Good evening and welcome to the show, Bharat. We are going to talk about systematic withdrawal plans today in depth, but then let's just understand the concept first. What exactly is a systematic withdrawal plan?
Thanks, Kavita, for having me on the show. Uh, Systematic Withdrawal Plan. Uh, all of us are very familiar with Systematic Investment Plan or SIP. And especially in the last 5-7 years, SIP has become a household word. Everybody knows that you can put small amounts on a monthly basis or even at regular intervals and build up a large corpus over a period of time. And this has been very popular with the Indian investors. This has also become a large force in the market. SWP or Systematic Withdrawal Plan is exactly the mirror image of SIP, which means you put up a lump sum to start with, and over a period of time, you withdraw small amounts to take care of your cash flow needs. So, this in short is Systematic Withdrawal Plan or SWP.
All right, interesting. Bharat, now let's further divide this particular concept in different on different parameters. Let's try and understand it that way, because although a lot of time we see that SWP is something that senior citizens, or maybe after retirement, if someone wants a regular flow of income, could be something that can be used. But now even for that, there is a certain amount of planning that has to go in your investment process, or at least when you start investing. I want to understand the calculation and the maths that one needs to do before they start investing in order to understand or to figure out how much would they know after a certain period of time. Given the fact that SWP is a kind of a feature that gives you every month, or what in whatever intervals you want a regular flow of income, but one should know how much do they want and one should invest accordingly. So what's the maths that works over here?
Okay. So, the, as you very rightly pointed out, there are two stages when one is earning an income and accumulating money, that we call the accumulation stage. And in the retirement stage, you have already built up a large corpus during your working years, and you want to withdraw the money for your expenses. So, this is what we call the distribution phase. So, SIP is useful for the accumulation phase. SWP is very convenient, very flexible option in your uh, retirement years, or when you are taking money gradually out of your investments which you have built over a long period of time. Now, uh, one very important part is what I get is a cash flow, but it is not necessarily charged to tax as income. And I think this is one of the beauties of the systematic withdrawal plan. I try to keep it in a simple example. If I have invested, let's say, 1 lakh of rupees, and I have invested them in an instrument or in a fund, mutual fund, where the annual expected returns for the next 3, 4, 5 years are about 7%. Now, this is something very similar to a bank deposit. So, the good quality debt funds may be able to do something like this. So, if my 1 lakh is going to become 1 lakh 7,000 for the next 1 year, can I withdraw about 5,500 rupees every month, so that I will get a cash flow of 5,500 every month, and at the end of the year, I will still have my 1 lakh intact. So, keeping my capital intact, getting a regular cash flow, and distinguish this from income, because in the first month when I withdraw the money, I get 5,500, out of which only 50 rupees may be due to the appreciation or the taxable income, and 5,450 rupees may be coming to me by way of withdrawal of my capital, which will not be taxed in my hands. So, in this fashion, if I withdraw this money over the next 1 year, my tax liability will be very, very low, as opposed to a bank deposit. In a bank deposit, what happens is if I put the same 1 lakh in a bank deposit with a view to earn 7,000 rupees as interest, this interest will be taxed every year in my hands. First and foremost, there will be a deduction of tax at source or TDS. And then when I get that income, if I'm crossing the minimum taxable bracket, then I'll be taxed at 10%, 20%, 30%, whatever the rate may be applicable to it. So the systematic withdrawal plan gives me two benefits. It gives me a cash flow, but it gives me an income which is much lower than what I would have be taxed on in case of a bank deposit or a bond
Taxable
or a
amount.
company.
So you mean the taxable amount will be more as compared to an FD income over here?
Taxable amount will be much less. Taxable amount will
Okay.
be much less. So,
Okay.
yeah.
All right. Also, I wanted to understand SWP is offered only by mutual funds. That's the kind of a feature only for investing in mutual fund schemes.
It's offered by only mutual funds, but all types of mutual funds, whether they are equity mutual funds, whether they are debt mutual funds, they are aggressive hybrid funds, they are defensive hybrid funds, or even the balance advantage funds. All type of funds, you can have a systematic withdrawal plan.
Capping or any restriction on the limit of how much can be withdrawn per month?
So there are two limits. One is minimum amount that you must deposit. It is 25,000 rupees, and the minimum amount that you should withdraw is 1,000 rupees. But now some mutual funds have also come out with a facility where you can withdraw 500 rupees and increments of 100 rupees after that. So you can say that I want to withdraw 600, 700, 800 every month, and this can also be created on a monthly or quarterly or yearly basis. There is no compulsion that you must withdraw something on a monthly basis.
You said 25,000 deposit. Now, what is this deposit? What does it mean? Because when you're investing in a mutual fund scheme, it could be an SIP. So every SIP needs to be a 25,000 SIP or a lump sum
So
25,000.
the account balance will have to cross
Okay.
25,000.
The account balance. Okay, all right.
Right.
So what is actually the protocol in order to avail this particular benefit? You have to fill up a form. What are the technical formalities that you need to do?
You're absolutely right. It's a very simple formality. You have to fill a form and submit it to the registrar or to the mutual fund office. It may take 10-15 days for the SIP to be registered. And your bank account, which is registered at the time of investment, the same bank account can be given for getting the withdrawal money directly into your bank account. So it is not at all a cumbersome process. It's a very simple and straight process.
All right, so I think that will be all about SWP, Systematic Withdrawal Plan, that investors need to note down, and an excellent kind of a feature where you can have a regular flow of income or the way you want money from your investment portfolio. Thank you so much, Bharat, for removing time and helping our viewers with that today. On this note, we'll take a quick break, but then post that, let's figure out how can you accumulate 10 crores in 10 years, and if 10 lakhs is something that you can invest right now after this break.